Well, hi guys, my name's Chris Weston. As I'm speaking right now, we're just watching the pound getting absolutely decimated. So it's an absolutely brilliant time to bring in Kasravi, one of the guys I speak to quite often, and he speaks often about the pound. So this is a great time to really focus on this. We're going to be talking about all things trading today. We're going to have a heavy influence on the currency markets. Miad's an expert in this field. He's been trading for a long period of time. Before we go into that situation, there's two things I want to do. First things, if you like the video, hit the like button, subscribe where you can. And there's a question panel. If you've got any questions whatsoever, we want you to be involved in this. We're going to be talking a lot about Miad's process, about what's going on in the fundamental situation. We're going to be talking about the technicals, and we're going to be placing some trades, hopefully. So jump on the questions, anything at all. Just feel free to get involved in the conversation. But we're seeing the pound getting chopped up as we speak. And I'm going to bring Miad, and actually I've got my colleague Luke Suddards from our London office, who's probably feeling it on the ground over there at the moment, the tremors coming from the Bank of England. But Miad, welcome to the program. Welcome, Luke, as well. I'm going to start with Miad. Welcome again. Just tell us a little bit about Speculators trading and what you do there for your clients and for your subscribers.
Hi, Chris, and thank you for bringing me to this interview. Thank you, Luke, making the time. I know it's quite late in Australia. Thanks for putting this together. What we do in Speculators trading, what I did when I started it, I started with one goal in mind only, and that is to keep traders that are opening a trade, keep the good, profitable trades on for longer. Because once you're in a trade, once you made your mind up, it's very difficult once you get hit with conflicting news, with noisy price action, and some traders get out of trades too early. So what I try to do with my macro analysis, backing good trades, give them the confidence to stay in good trades for longer, or if they need to make an adjustment, do that but with the confidence that I have some good macro knowledge behind it. This is really why I started Speculators trading, and this is what I teach on a daily basis. What are the macro drivers, what are the risks? For instance, like today we have the BOE announcements. GBUSD was already on the feelers out for selling it. I've actually sold it right there, put in the group chat as well, because the way that the news came out was hugely in favor of selling GBUSD. We know that because of the macro drivers.
Can I just jump in quickly? I just want to bring up the risk warning before we go. We're going to talk about the strategy in a second, but I want to go straight to the chart and see what you're seeing. So if we could just bring up the risk warning, just 2 seconds, please, everyone. I just want to say that everything you're going to hear today from myself, from Miad, most importantly, and also from Luke, is general in nature. It shouldn't be construed as personal advice. We will be giving hopefully some views on the market, some strong views on the market, maybe some actionable ideas, but you should not consider them to be personal advice. We may touch on crypto. We need to understand that we are regulated in multiple jurisdictions, and crypto is not permitted in places like the FCA. So again, if we do come out with any strong recommendations or strong views, should we say, please do not consider them to be personal in nature. They need to be general advice. You need to do your own research. So before we go into the strategy, Miad, I want to go straight to this pound move, because it's just been chopped up. It's been taken to the woodshed and chopped up into little pieces. So you can see your chart there. I mean, straight off the bat, when I'm going to get Luke's view in a second on I don't know if he's had a chance to see what's going on, but what are we doing here? What are we doing on this move right now?
I started selling it the moment the news came out. Now we started selling a little bit more. Don't know if you can see my screen, but I just had to close it right there, and for about $700. See, the thing is, market went into the meeting lopsided. That to me, that's a trigger for our trading strategy. When you have a lopsided market and things don't pan out as market wanted, they all have to get out of the position all at once. So there's nothing really stopping this dramatic move lower now in GBUSD. We had the entire week starting from Monday. Bidders keep coming into the pound. Now they kind of got upset. They didn't get the hawkish feel they got from the Federal Reserve, and was a bit unfounded if we had to think about it. And now market wants to get out of speculators want to get out of their long positions and that's just drive market now in the one-sided direction for the beginning of the move. So you might get a little bit of a chop, but seeing as it is, it looks like pound is a little bit on the should continue on the downside for the remainder of the week.
Well, you've got a 1 minute chart on there. I'm just going to touch on Luke. I mean, Luke, you cover the Bank of England quite aggressively, and you know, I think Miad's now brought that. Is that a 1 hour chart you've got, Miad?
That's our 1 hour chart. And I've marked out here the daily open for us. That usually is quite important around these events. I've marked out 50 pip zones above and below the daily open, because from my previous experience with the BOE announcement, market tends to fade these zones regardless of what the outcome is. Yeah. So I was hoping to, if I get an algo move into any of these zones, I was hoping to fade them. But because the news was kind of in the realm of my research, I just started selling there and then, and kind of held my stop loss behind the daily open, and closed it at the 39.10 just now. We might still get another trade, so this might not be the end of it. But
so do you think would you be looking? We're looking for a bit of strength to sell into to get down to that 138.54, that lower yellow horizontal level.
Yes, I would like to see that. Makes more sense right now. See, again, we had this build-up of bullish longs, bullish positioning, and I'm feeling like they're getting now a little bit worried that they didn't get the hawkish messaging. I probably should go and read the statement a little bit more into detail, but seeing the vote gives me the confidence that I needed that Bank of England wants to stay put throughout the summer.
Yeah. Luke, I'm going to quickly flip to you, mate, because as I say, you cover the Bank of England pretty intensively. Have you had a chance? I mean, what was your expectancy? Have you seen the headlines which justify this move lower?
I think what we've just seen right now is a couple of traders which were going into the meeting positioned quite hawkishly, and now they're getting out of their longs on, and that was on the basis, their sort of thesis behind that was that potentially, and outgoing chief economist Andy Haldane was going to maybe shift some of the thinking across the broader members within the BOE to join him in ending asset purchases beyond August and trimming their envelope by 50 billion sterling. So that's what we're seeing right now, is a couple of them getting out of their position and repositioning themselves on what I thought was probably going to be an unlikely hawkish surprise because of the uncertainty around the furlough.
Well, I think that the Fed have probably moved a little bit further, haven't they? So they've probably given a lot of other central banks a bit of wiggle room to become more hawkish. So it sort of feeds into what Miad was saying. Some of the expectations were up there, but Mia, going back to this chart, and again, we're going to crack on with your strategy because we want to know how you trade and the process that you follow. But this move's really interesting now. I mean, it's still sort of just hovering around there. Does it? You know, instinctively, having traded these sort of moves before, does this feel now that we get a recall back up for the retest of that former breakout range, or do you instinctively? I'm not saying you need to trade this now, but you know, how does this gut play out based on previous episodes here?
Looking at it is, because we had quite a bullish shoot, I would need to see a breakdown of these levels. So what happens is with the Bank of England, the trade isn't usually right straight after the announcement. The good trades come after the London fix. I'm going to quickly take us back to the last meeting, which was the 6th of May. And the London fix, which occurs at 4 p.m. London time. Yep. A lot of banks do back and forward deals, and they come to a conclusion, let's fix the price at a certain level. So this is 6th of May. We had the London fix at around here, right? So this candle here would have been the London fix. And market made up its mind after the London fix where it wants to go. So this is where I'll be involved for a swing trade. I can show you the past 3-4 meetings as well. Exact same scenario. Yeah, right. Market makes the big move after the London fix.
So you're looking for that today. You're looking at today at 4 o'clock, looking for a similar situation to play out again, Miad?
Yeah, so I'm looking for the 4 p.m. fix to come and go, and then I'm making my mind up where I want to trade it. I like to say I want to trade on the short side because it makes more sense. But right. I'm happy to wait for the London fix because it gives me a better opportunity to manage my risk, as in stop loss.
So talk to people out there about the London fix, and it gives you an element of predictability, which can create an edge for you, right?
It does. So you may or may not know. I'm just going to give everybody a quick explanation what the London fix is. London fix is a some that started in the 90s, the big commercial banks between each other, they all fixed the pricing of a lot of cross assets and currency pairs, particularly on a certain time of the day at 4 p.m. That means if people getting cross-quoted from different companies, the banks are all given the same benchmark quote, because throughout the day, the currencies move quite a lot. And once they have the benchmark pricing, you can do business around it, and you can actually value your portfolio against that pricing fix. So what happens is, for banks to be able to make business around that price level, they need to build inventories. They start doing a lot of buying and selling, options hitting the market, pension funds hitting the market, right to the run up to the fix. Every single day, you're going to see one of the highest volumes throughout the day. And there's not even any news around it. So I started to pay a little bit more attention over the last few years. Is there maybe a strategy I can work on? So I worked more towards GBP-USD pair and also other GBP crosses, and it's working really fine. We see that price keeps bouncing off the London fixes. If I show you the last London fix, which was around here, we can see that price stabilized. So this was the London fix at 139.67, and price did not really move that far away throughout the entire day. Use that as a podium to drive shorts. So you want to pay attention to these on a daily basis. In the course, I actually teach you strategies, how you can do swing trades out of these, how you can do day trades, but also how you want to be positioned around central banks or post-central bank meetings with the London fix. It's quite an interesting thing in the Forex market. I feel like a lot are missing out.
I think that's interesting. And so as part of your offering in your channels, you'll discuss the London fix, how you think it's going, the behavior going into the fix, the situation there, and then offer the trade around that once it's come out. Is that how you see things?
Yes, mind you, see, the London fix gives you the opportunity that you can wait. One of the biggest problems we traders have, we're not always sure, should I get in now, should I wait, should I maybe go half a position and then add a little bit lower? You know, it's all these questions you're constantly asking yourself, being able to answer them. The London fix takes all these worries away from you. You know, you have to wait till a price comes due, and then you have a level you can work with. Either you want to be short or long. That gives a lot of confidence, and it takes a lot of stress away from the traders. And to be able to operate peak performance, I like that a lot. When I see traders use a London fix effectively, it really shows them how they shine.
Yeah, nice. Let's talk about your process then and your strategy. So you talked about the fix. That's one element throughout the day. But do you apply other strategies outside of that 4 p.m. window? Do you trade momentum? Do you trade swing? Do you scalp? What's your do you trade multiple different strategies depending on the volatility in the market? Talk to me about Miad's strategy or strategies.
Yeah, thanks for asking that. My strategy starts from off the chart. So London fix is a way to get into the trade, but really my work is 90% of the time away from the charts. We're doing research, we're doing analysis, we try to understand each asset separately, and I can talk your ears full of it. Let me show you this really quick presentation I did.
Go on.
Regarding this. So I wrote a quick strategy guide a few years back, and I'm going to that's like 3 or 4 trades. I'm going to talk you through this. Takes a minute, and
go for it.
Understand what the strategy is about.
That's lovely.
In 2017, Argentina suffered a drought, and that meant half the soybeans crop would have went to waste. So Argentina is one of the biggest exporters of soybeans, and a lot of were looking towards them to be able to buy soybeans, to be able to supply to the fodder for the animal feeds or for industrial use and all these other things. So soybeans was about to hit massive shortage. There was a huge supply imbalance in the market, and there was no way of stopping it. And be able to grow crop of soybeans, you need to be able to do it like six months, at least a year ahead. So all of a sudden, then hits the market, and look at that. So this is the soybean chart. It did nothing for a month, 6, 7, 8 months, did nothing. The price breaks out. The news breaks out, and price just goes on a rips everybody's face off for 3 months ongoing. And it doesn't matter what indicator you had, what analysis you would have used, there was nothing going to stop this move because people needed to buy soybeans and there was none to be found. You could have used the 5 EMA, 10 EMA crossover, you would have made money in this market. This is what I'm interested in. Let's fast forward a year later, 2018, around May, June, the Bank of England make everybody believe they're about to hike rates. Now come to the meeting, and back in the day, Mark Carney says, you know, the rate hike I talked about, let's put a pin on it because I'm not sure I want to go ahead with it. Everybody was shocked because everybody was already positioned for that rate hike. So it was billions of pounds that were exiting the market. Pound dropped over the course of 2 weeks near to 1,000 pips. That's a massive move. Look at that. Nothing could have stopped it. Again, that's where I want to get involved. Lopsided market, momentum, some news breaks that nobody can stop it, and just a one-sided driven market. You just wake up and just buy or sell the same thing, and you're very, very certain there's pretty much nothing can stop it. I'm going to show you another example.
Please.
Just to drive this home. AUD/USD 2013. George Soros says, you know what? I think the RBA needs to cut rates. So that's the Reserve Bank of Australia, because they need a lower currency to be able to operate and all of that. And everybody knew George Soros in the 90s. He absolutely crashed the Bank of England. With betting against them. So everybody thinking, oh my God, is he going to do it again? And of course he did. So he does the bet a couple of days before it. The news came out, RBA will have to cut. They didn't cut once, they didn't cut twice. They just started a new regime of cutting rates. And you can see the charges, again, went on a one-sided slide. Nothing could have stopped that. Actually, Soros got out of the trade a couple of 100 pips after that. But reasons remain. There was a one-sided market, lopsided. Nothing could have stopped it. That's the sort of market I want to get involved in. I feel like you're getting the feel for my strategy here. I'm looking to see what's happening in the market, and something breaks. One side is very lopsided. Momentum is there, and I want to be sure that there's no much that can get out of there. Or we don't want to be in a position where you think there's loads of outflows and there's nothing stopping it. Last example here is the Turkish lira. There was political turmoil. International bond portfolios that they had in Turkey, and there was just massive outflows out of the Turkish lira, and it crashed the Turkish lira about 8%. And just about when everybody thought it stopped, Japanese investors' stop losses got hit, and it crashed another 2 or 4%.
That's right.
In a very short time span. So this is, again, one of those situations where you want to get involved with. It's just a one-sided direction move and not much in the way of it.
Yeah, nice.
That's my strategy.
Yeah, great. So I'm going to ask a question, because what you're doing is you're looking for, you know, we're trading an OTC market effectively. There's no, you know, physical exchange on cash effects, but you're looking for those that order flow dynamics where basically no one's really offering anything. If you're looking for an uptrend, you're looking for that feel of very few sellers but a lot of buyers coming through, and that buying pressure's just ripping the currency up, and obviously vice versa. Within that strategy, so you're looking for that one-dimensional, you know, not a lot of buyers, a lot of sellers, and vice versa. What indicators? I mean, is it just price action you're looking for to tell you that, or do you use, like you say, 5-day exponential, 10-day exponential? What do you give indicators to give you that kind of currency, that capital flow in one direction, and to give you that high probability situation?
Again, it's very difficult to be able to use anything on the charts to be able to tell you when these things happen. These things are dynamics that happen away from the charts, which you find out through news, which you find out from macroeconomics. You find the imbalances not on the charts but off the chart. Price action is just the very, very last thing I look at when I want to get into the trade, to see where I can get cheaper with a bit more cost-effective stop loss. That's all chart is for. It doesn't serve any other purpose for me. So using indicators, using crossover EMAs, you know what, they're all great as long as you know what side market is going to move. If you were trading BOE today, you wanted to sell pounds, it did not matter what you have used. As long as it gave you a sell signal, it was the right tool to use. You could have sold on a normal support breakout, and you would have made money today.
Mia, I just wanted to ask you, so when you're going through the slides of your previous trades, you obviously like to trade big events, and with big events comes lots of risk as well as lots of rewards. So as traders, I think something that people don't really focus on as much is managing their risk. So how do you do that around those big events? How do you effectively manage your risk, and how do you position size around those events?
I think, Luke, what you're asking is, how do you protect your downside? How can you make a shitload of money out of this big news? The thing is, these events happen so far apart. These big good events, they happen so far apart. So all you really want to do is, in between, not lose your pot. because you need that pot to go in heavy when it's asked for it, because that's where your money is in the end. I became full-time trader because I've been able to capitalize on these events. I don't make my money out of this week-in-week trades. They're nice to have. A couple of $100 there, a couple of $1,000 there. That's good. That's not really life-changing money. That's not going to change your being as a trader. Really, what you want to do, the majority of the time, 95% of the time, your risk is going to be extremely low, 0.5%. If you have a good week, maybe 1%. And you just model through, and then bam, out of nowhere, these big events happen where you just know. You've seen it before. You've done a research. You just know, okay, this is the event I was waiting for. Time to go heavy, maybe 5%. And then that 5% goes into profit. You can use the profit and then accentuate that trade. This is how you manage. The majority of the time, there's no need to offer market any particular huge amount of money. And those rare times, something like that happen where I just showed across the charts. This is where you want to get really interested, really heavy. And this is where you can make the bulk of your money as well.
You go into that. You've got the 1 hour chart up at the moment of cable. You've got that swing low that you can see just to the left of obviously where the current price is at the moment. Price is just holding that level. We've traded below that. Yeah. So that series of lows there, which we try and put a bottom in, we've traded below there. You can see the candle on that situation there. The buyers have stepped in and supported below that level. That seems significant. Can we get another, if we get a break or a close on the hourly below that level, would that indicate that to you that we're probably ready to make another leg lower and you trade that from the short side, or what are you looking for now?
I'll be taking the afternoon to read the statement, to see put my feelers out, see if people are getting really scared. See, the thing is with the Bank of England, they will be doing tapering anyway. They can't keep the QE on forever. We all know that. That's why it rallied in May. That's why it rallied since the start of April. It's just really the timing that's going to put the wrench in the works. So I'm going to read the statement and see if I can figure out if the timing is a bit more imminent. If the thought process is that, look, they're going to have to move within the summer, then yeah, I'll be looking for longs. Again, after the London fix, this level here means absolutely nothing to me. I want to use some that have statistical advantage with, which is the London fix. But this level looks like you're right. They're playing about it. Could reject it, and you know what? We might not see a lower level than that. But I'm not certain, and I need a little bit more statistics to back these trades, specifically when it comes to technical trading. So for me to have that confidence, I need to spend a couple of hours really deciphering what they said in the statement, see what the differences was in the two-part statement. I cannot stress enough, Bank of England will have to taper. There's so much they're going to do QE. I think the worry was a little bit, England didn't fully open in June where they're supposed to, so now they're kind of holding down their hands. A little bit people are thinking about the full low, what happens when that gets lifted. So the timing is just pushed back. It's not fully diminished. So for me to be able to get that bullish vibe, I need to be able to understand that. And I might not even trade it at all this afternoon if I don't understand. I'm not afraid not to trade. That'll be set.
Yeah, absolutely, 100%. Luke, have you had a chance to look at the statement and give any clarity on what we've seen, or have you had a chance to see what the sort of general feel is from the headlines that have been going on?
Yeah, the general feel has been the Hawks have been disappointed and the Doves are taking control at the moment. They're in the driver's seat. In terms of statement-specific language, I haven't actually had a chance to go through it with a fine-tooth comb as of yet. I've just been trying to monitor the tweets coming out. And yeah, there was a lot of talk about how, inflation, it's too early to tighten. Inflation's transitory and there's a lot of downside risk still. So I think it was a lot more dovish than some had expected it to be. Yeah. And that's the reaction we're seeing now.
Cool. May I question from Alan, FX options expiry. You talked about the fix being obviously a predictable time of one day, but options expiry obviously play a big part in the flow as well. Dealers who have sold calls needing to gamma hedge and various factors. Does that ever play? Obviously, that's a set time per day as well. So does options expiry play into your thought process as well, or is it just the fix and news and economic data?
Option expiry will give you the volatility, which is great, and it usually coincides with New York cash open as well. It gives you volatility. It's all it does. I'll never be able statistically to tell you if option expiry will be a positive or a negative event, or what happens after it. you pretty much never know. There's some rare times where gamma squeeze has been driving market one direction, fair enough. But the majority of time, I've never found an edge. With a London fix, I can tell you edges up to 70-80% probability on a monthly or weekly basis. With the options expire, we'll never be able to do that.
Yeah, no. Can we flip charts? Let's have a look at some of the other sterling crosses and see if there's anything. I know you're talking about waiting in cable for 4 p.m. to get that statistical edge, but I'm just interested to look at the setup now and see if there's anything more pronounced in, say, sterling yen, sterling Swiss, you know, and if there's anything that you would do prior to that fix. Is there anything right now that you'd consider doing?
No, again, at this point, sit and wait. In my experience, the bigger moves happens after the fix, so it gives me the time now to just chill out, figure out what's happening, what I want to do. And honestly, once you know in trading that you can wait, it's one of the greatest things. So you don't always feel pushed that you need to do something, even though price move. From my understanding, this should waffle about for now.
Yeah.
And price is going to go on a bender and just make everybody annoyed, and everybody's going to have an opinion. But after that dust settles a little bit, then we can make a bit more educated decision.
Wicked. All right. Do you know what we're going to do? Let's take the pound out of the equation then, because it's as you say, it's messing around a little bit, and you know, I think the Bank of England is going to be a fairly myopic affair. It's going to be focused very much on the pound, maybe to an extent the FTSE and some of the banks and various factors. But let's take the pound out of the equation. Let's have a look at dollar yen. We got a question earlier on from one of the viewers about dollar yen. If you go to the setup there, so what time frames do you initially look at the currency pair on and go through your process? Are you seeing anything on dollar yen there?
When you mean time frame, do you mean like in terms of trading it or in terms of analyzing?
Well, I guess you'd probably look at the analytical side of things first, and then going into the trade, right? So, would you start with like a daily to look at the overall structure of the market, and then maybe go into the hourly or below to actually get that move, that entry point?
I think a lot of traders do that will help them. For me, it will just distort things. I don't know. If I look at this, that looks like, I don't know, maybe looks like resistance. People distort my thinking. My understanding is why did this rally all year? Why is this rallying since the 6th of January non-stop, 835 pips? And then this resistance is supposed to hold it off, and if yes, why would it do it? And understand yen. Yen usually moves with the economic cycles, PMIs, inflation, and yields affected a lot. But right now what you have the Fed saying, look, we will probably need to taper at some point this year. We're going to raise rates 2 times, not once, but twice by 2023. You have the Bank of Japan saying, I think we're about to ease again. So you have 2 central banks saying total different thing. I have no understanding why USD JPY should be trading here. It should be way, way higher. It should be 500-600 pips higher, in my opinion. But why? So why isn't it? Because of obviously the way that market is moving, the way orders come in and out, and Forex doesn't always move exactly where it needs to be over a short period of time. So in my opinion, it should go higher. There's 2 things that's going to make USD JPY struggle right now to move higher. I'm going to take you quickly to the US short-term yields. So this one you can see is US 2-year yields. US 2-year yields, again, quick explanation. I know you, Luke, and Chris know about it, but maybe everybody else haven't heard about it. US 2-year yields are very sensitive to interest rate moves. So if the Federal Reserve starts raising rates, you will find that this will move higher as well. Since last week, where they said, look, we're thinking about tapering, everybody got their mind together. Look, I think they're about to raise rates, and they pushed this thing up. They pushed this thing up to a level where it's right now not sustainable. They are not about to raise rates right now. It shouldn't be really trading above 0.25. And now, look at that. If I were to overlay USD JPY with that chart, it kind of gives you a feel that the 2-year yield, USD JPY, are not that far apart. Okay, the magnitude, the way they move is different, but the 2-year yields could offer USD JPY a short-term ceiling before obviously this ends up breaking higher. But what is certain, the next move in the Federal Reserve is a rate hike, not a cut. That means this will move higher. In my opinion, that means USD JPY should be moving towards 115, anything from now until the following year.
Yeah, I'm the same. I'm going to get Luke's opinion on this as well, because next Friday we've got
non-farm payrolls. Yeah,
non-farms. We're looking for 600,000 is the consensus there. I'm glad that you brought that up because it's something that's very close to my heart. Is how the bond market affects capital flows in the FX market. Obviously, the higher yield that you get on a relative basis, relative to say Germany or the UK, you're going to see capital flowing to that place. Just because its attractiveness as an investment destination, amongst other things as well. But obviously, if we get a strong payrolls number, if we get a strong ISM manufacturing number, that just accelerates the need to reduce that pace of the balance sheet expansion QE. And I think you're right. We're looking at short-term yields. Some people look at 10-year or further out the curve, but I actually quite like the dollar. And I think you're right. The dollar yen is probably your best play event against that, because if we're seeing higher equity markets, then dollar yen gets the risk on boost on that cyclical bounce. But then you've also got a situation, if we do see a better data and the Fed continue to get hawkish into the Jackson Hole Symposium in late August, then dollar yen is going to do well against, or dollar is going to do well against the funding currencies like the euro and against the yen, for example. So I sit in that camp as well. I mean, I don't know what you think, Luke, but I like the dollar yen higher. I think if it breaks through that level on a conviction basis, then that 2-year yield that Mia brought up is going higher, and I think that will be going up to pick a number, to be honest. But it's I'll be certainly looking for 113, 114 in that mix. What do you think, Luke?
Yeah, I also like longs on the US dollar JPY. There's a little flat-sided ascending triangle pattern that's formed on Miad's charts there, the resistance, and looks like it's pushing through there. The RSI has got plenty room to run before it becomes overbought, but I think yields is going to be a big theme for this currency, and it's been from the beginning of this year as US 10-year yields reprice higher as we reach more normality. And I definitely think the dollar is going to strengthen against those funding currencies, which is JPY, as well as the euro, as their monetary policy remains firmly anchored due to historically weak inflation. They have to keep the foot on the accelerator because of their past. Whereas, the US is spitting out 5%, almost 5% inflation on a year-on-year basis, and we've got that core PCE read tomorrow before next week's important non-farm payrolls too.
Yeah, Miad, you talk about using fundamentals and technicals together, and you want to look at the Bank of England statement, understand how that could affect sentiment. We've talked about other factors, but one of the other factors that a lot of retail traders talk about is the commitment of traders reports. I don't know if you look at that at all, and how much significant weighting do you put, when you see extremities and extreme positioning one side or the other? Do you look at that report?
Yes, CFTC.
Yeah.
How to put it? You need to understand why they're buying and selling. So you can't just look at the data and think, "Well, I know everything about what the CFTC is trying to say," or the data. You need to understand why did they reduce positions, why did they add positions. For instance, if you looked at last week's, right, net short positioning shows increase, right? That's plain simple. But if you actually look into the details, really what happened is euro longs reduced, euro shorts reduced more, and it looked like that dollar shorts increased. It didn't. Nobody opened any new positions last week. Nobody did. They all just reduced all their positionings, short a little bit more. CFTC data shows, well, a dollar shorts increased. So you really have to use your brain a little bit. Don't just look at data, think, oh, this is bullish or this is bearish. Another thing CFTC data is useful for, if the opposite happens of what market thinks, you know how many people need to get out. For instance, if you're bullish pound and something happens that's really negative, like today, there's over $2 billion needing to get out of the pound position. So you got a good way down for that to flush through. That's what CFTC data is good for. Since I've mentioned that, there was about maybe 18, maybe close to 20 billion long euro 2018, right? And everybody thought back then in the day, Draghi told, look, economy is good. So it was trading in this range, right?
Yeah. And
come around April, Draghi said, you know what? I know I said the economy is good, but I'm kind of feeling like we're maybe going down into negative territory and CPI is bad. And the 20 billion just wanted to run out. It all ran down. Look at that, what happened there on this chart. Nothing stopped it. That's what CFTC data is good for, because you know how many people need to get flushed out. So you kind of get yourself a nice target in terms of trading. But on a day-to-day basis, really understand why they're adding, and then look a little bit into the details. Again, last week, a lot of people were reporting that dollar shorts added, increased. It didn't. People were just reducing their positions, and the shorts reduced a little bit more. So open interest actually lowered. Nobody opened any new positions. There was not a bullish factor whatsoever.
How if you get one of these moves, right, and you get on the right side of it, one of the things that I always see from a lot of retail traders is people taking their profits way too early, and they let their stops run too much, to be fair, and that's something that we try and do. The opposite of as pro traders is try and let our profits run. So you're going on, you're seeing one of these big runs up or down. How do you take profits on that? How do you let your position run to max out, to try and extrapolate most out of a trade there?
Once that click happens, where you know, okay, here's the big bang. You want experience, you want quick reaction time, you want to be willingness to take risks, you want to be aggressive, judgment of information, emotional stability, because moves are going to be massive. You want lasting style of thinking. So a lot actually goes into it to be able to make money out of these larger moves. It's not like I just hit the buy button and just wait until I take profits. A lot goes into it to be able to stay into those trades. I'll be able to tell you, okay, just read the news, you're going to be fine, or just use the retracements and add to it. It's very easy to say these things. Once you're actually in a situation trading these things, everything goes out the window, and all you can fall back to is all the things you already taught yourself. Again, aggressiveness, willingness to take a risk, judgments of information sources, because a lot of information will come out at a time telling you, no, it could go back up, which it did back in 2018. A lot of analysis came out that USD can go back up, but it was keep crashing. Every single week was just crashing 300-400 pips. So you need to be able to decipher the noise in the market. It's really important. The only way you can do it is through experience. And when you have the experience, you have the confidence to trade these things. The way I do it, the way I ideally like to do it, once these moves comes, I start with one position. Once that goes into profit, I use that profit, that floating profit, to open a second, so not to take away anything from my main capital. This is the ideal place where I like to be, and just build this like a snowball.
Miad, we've just got 2 questions come through from Lucas Adams. He says, do you remove the currency pair if your strategy doesn't work on this pair? For example, if you trade 20 times on GBP AUD, would you remove this from your watch charts? Would you stop trading it?
To be able to answer you, Luke, I need to say this. Each currency pair, total different strategy. I can't trade GBCHF the way I trade GBUSD. I can't trade oil the way I trade gold. Not even I can analyze them, because they're just different currencies, different countries, and different volatility, and they move different time of the day. There's sometimes where everything moves nicely together, but the majority of the time, specifically if you do it intraday, nothing moves the way it's supposed to. So you need to really have awareness of which currency pairs you trade. Now, to answer the question, do you remove these? I will never remove them, because they're there, and they all give me confluence and correlation for what I need to be able to do is to decipher where market is headed. Every day when I start my trading day, it's all sentiment analysis, and I use my sentiment looking at these charts. For instance, let's look at today. GBUSD is crashing. Well, not crashing, but it's down about 30 pips on the day, nearly 0.5%. Euro USD is up 14 pips on the day. So it's not a dollar move, it's a GBP move. I think that happens all the time.
I think what Lucas was asking was, if you lose a certain number of times, is there a point where you say, right, my strategy isn't working on this currency pair, do I need to actually remove it from my investment universe?
You won't remove it. Sometimes you feel like, I feel not connected to a currency, you stay away and you come back. I felt disconnected with gold in January, so I stood back. And usually the thing in January is just buy gold and wear diamonds. This year was different. It wasn't working at all. So I had to step back, but I still trade gold. I need to come back to it. It's just sometimes if you're out of the rhythm, yeah, step back, but do not delete it, because these opportunities always coming up.
Yeah. Okay, I think that answered that great. And then just Francis wanted to know your thoughts on Euro JPY. Miad, if you could maybe pull up that chart and just run through
Euro
the basics.
JPY yesterday was really important for everybody who was watching market. Now, PMIs are really important to Euro JPY. So as long as PMIs increase, you find that Euro JPY will increase with it. We're all expecting the German bond comes down a little bit, yields go up. So overall, it's structurally bullish, right? So I think you've got to come back to this chart. It's sitting at 132. Next year, I'm very confident it should be higher. But you don't want to hold it for 12 months. You want to know what happens now. And I found a little trick with volume analysis that when you see stuff like that, when you see these moves, these retracement moves, but with lower volume, I'm always worried. Why is this happening? It feels like there's no buying power. It feels like maybe this is a weak retracement and it could see lower again. What I suggest is in the short term, Euro JPY should come down. Maybe not all the way down to 130, but I think it's going to come down. In the long term, as long as the economies are good, so follow-up data, you should be okay. But if you find that PMIs are peaking, you want to cram shorts until there's no tomorrow.
You've seen that if you just scroll into the chart a little bit more, you've seen that big squeeze to the lows on the third bar back. You've seen the big rejection of the prior lows. You've seen markets squeeze back up and close, not above the previous day's close, not quite above the previous day high. So a really strong rejection, and we've seen the follow through in the next day. Would you have traded that move there because you've seen the rejection, the buying above the previous close, and then the follow through the next day? Would you have looked at that situation at all?
Yes, I really liked it. I think I was a bit more jittery from last week, the Fed. I wasn't too certain how is this all going to revolve. So by the time this happened Monday morning, I was flabbergasted. I was just looking at this all and thinking, oh man, this is all turning back here on us. I was actually trying to short pounder that day. Got a bit wrong-footed, got out very quickly, didn't let my stop loss get fully triggered. But yeah, I would have traded that. Yields were moving positive that day. See, another thing I'd like to mention is this move from last week wasn't all the Fed. There was options expiring on the SPX. A lot of brokers just were selling their stocks because they didn't need to hedge anymore, and that kind of just soured the entire move of the market. And these next 2 days, so starting Monday, Tuesday, Wednesday, it was really just neutralizing all the nonsense that happened last week.
All right. Yeah. Well, you've got a bit of indecision playing through. You can see that doji playing through there now. I mean, would that trigger anything for you? I mean, you're just looking for some flow coming either way. Would that interest you at all?
At this point, no. Again, see what happened here over the last couple of weeks in Euro JPY? Pretty much nothing. I think right now it's still in the same place, but pretty much there's nothing happening. What we're all thinking is, are PMIs peaking? I'm telling you macro, are PMIs peaking? Yeah. Services PMIs seem to be picking up still in Europe, but eventually I feel like they're about teetering out. That could mean Euro JPY will probably settle a little bit lower before it finds a leg higher. I don't want to get aggressive now. In my experience, is usually during the summer, Euro JPY is not really boding that well. So seasonality a little bit comes in play here as well. Last summer, we obviously just came out of the recession, was a little bit different. But by the time before that, summers are not really kind to Euro JPY. So it was 2019, 2018, not really nice as well. And 2017, even that when all the reflation trade was going on, most of June wasn't really good until later in July, things picked up. And 2016, 14, 15 was just absolute watershed moment for Euro JPY. So summertime is a tough one to try to hold the trade for Euro JPY. For me, because everybody's waiting what's going to happen once we come out of the summer.
Miad, because we went straight to the charts, I just had a question, and I think the viewers will find this interesting. I know I will. So what would you tell after your experience now where you are in trading? What would you tell a new young gun Miad starting out at trading? What would be one of the things you'd tell him to watch out for as he starts his trading journey that you've learned today from your experience?
I would say stop over-egging your analysis. You get introduced, like me, like everyone else. You start learning trading, you either take a course, and your education leads you to not making profits. And it doesn't mean really what you learned was wrong. It just means it was incomplete. Really what you want to learn is what are the drivers, how you're going to get it effectively, what are the tactical advantage in trading. You could be right on a move, but if you get in too late or too early, you bust it. So really, I feel like most people, their education was incomplete. They just need a little bit more oomph to understand these things. And second thing is, you're souring trading most of the time for yourself by taking unnecessary losses. You're making this whole trading for you too difficult and too annoying and too painful, like probably many others did as well. Stay away when prices on a bender like today. really understand what's driving markets. There's some certain times when things are easier to trade. This is where you want to get them off. That's where your money is. And there's some other times where your strategy isn't working well at all. Look at the weekly calendar. There's 3 things that probably I would say you do right now is going to change your trading forever. Look at the weekly calendar. You have guaranteed volatility every single week. I can tell you now where the volatility is next month because I can look at the calendar. You always get guaranteed volatility. You need volatility to make money. 2, look at yield spreads. Look at where the divergences are in trades. To see when you have one economy, the yield is moving high against the other, FX pairs will always move with it. I'm going to show you a chart in a little moment. And the third thing is, have a look at the London fixes. It will probably change the way, it will hold you back on a lot of trades. It will change the way you look at volatility intraday as well. Again, 3 things. Look at the weekly calendar, because you can save yourself a lot of time trading in the chart. You can use the volatility. 2, look at bond yield spreads between the countries, because the bond yield spreads will move before FX does, and FX will always follow. And the third thing is, have a look at the London fix, specifically if you trade pound pairs. A lot of fun happens around the London fix lanes.
Can I just ask on that London fix, and we'll ask a couple of questions because there's one that's pretty close to my heart. You look at the London fix, and obviously that relates to some predictable moves or some volatility around the pound, but do they have something similar in Europe that you look out for? I mean, if they got the fixings obviously all around the world, do you not look at other fixings that take place and how they relate to other currencies, or is it just specifically the pound?
You see, the London fix, every currency gets fixed, and you find that there's good opportunities on most of them. What you find is the level on pound pairs is just hits to the pip most of the times. But the other pairs, it might leak over before it makes the move. But there's other fixes. We have the Tokyo fix. We have 2 daily gold fixes. And I think there's a couple of other fixes that are quite prominent as well. And I'm sure there's people who are doing strategies on these right now. What I'm saying is the London fix will create a good tradable opportunities, specifically with pound crosses, but also on all other FX crosses. You will find good movements around the London fix. Month-end London fixes are really rowdy sometimes. I've seen Euro JPY move over 160 pips before the fix, just because people needed to sort out orders. Pay attention to it. I see a lot of traders taking bad trading decisions ahead of a London fix, and the technicals never will line up because there's just orders needing to get filled.
Yeah.
As long as you're aware of it, I think you will have a different view on the market.
Yeah, I think that's good, man. I think if people go to your website and you obviously spend a bit of time teaching people how to do that in a more predictable fashion. So I think if there's anyone out there who wants a little bit more information about trading the fix, which is something that Mejores talked about at reasonable length in this webinar, so you can go to your website and find more information on that, Mejores.
See, Chris, this is my website, Speculators Trading.
Yeah.
It's very simple. There's either a monthly subscription or you buy the trading package where you will learn about the macro drivers, you will learn about London fix. But what essentially it does, it will cut down your experience curve and your learning curve. So we're able to learn all of these macro drivers on your own over the next 4 or 5 years and how to actually translate into a trade. I'll be cutting that time down for you for 3 to 6 months. On a day-to-day basis in the trading room that I drive, I explain sentiment, explain what the macro drivers are, just like today by the BOE, for instance.
Yeah.
And then you kind of learn, okay, so bonds moving now, that means pound should go up. Okay, BOE said such and such, pound should go down. Same thing with yen, same thing with euro. And all of a sudden you start looking at market, oh, this is not a random walk anymore. We can actually predict some markets actually cornering itself, and I can get involved. To start learning these things. What I do differently from everybody else, I like to say, is I do live trading with live P&L, live position sizing. Doesn't mean I take your risk, doesn't mean you should trade all the ones that I take, because I won't be able to justify if you win or lose. But what it means is you can get to see somebody, how does he behave when he's in the loss? How does he behave when he's in the win? How does he treat the market when it's a bit choppy? How does he trade when he's got maybe 2 or 3 losses? Is he changing his behavior? He learns so much when he sees somebody trading live, with a live account, with a live P&L. It's just a game changer. It's much more difficult for me as well, mind you, because it gives you more burden to be able to obviously churn out profitable trades, but will give you as an onlooker a huge different look into how somebody drives this or trades on a day-to-day basis for a living. So I encourage you to come over, have a look. I'm right now doing a bit of a promotion on it. That means you could get maybe half price over the summer. It's a really low price, honestly. If you don't like it, you can leave. You can cancel anytime. I really find you will find. I'm sure you will find value into it, specifically about the live trades. Something I did this year as well, Chris, was we were trying to get people into prop firms. So some of the prop firms will have like challenges where you need to pass those challenges to be able to trade with 100,000, 200,000 capital. So this year I started introducing that, and I think I will do another one. It was successful. I rose over nearly to 2 million, over $1 million in prop firm money for different clients. I'm looking to do another one of this in this year. People like it. People get a bit more confidence. And when you have a bigger pot to trade with, I think it will give you more different lifestyle as well. That's what I like. Good
stuff. Right, we're going to go back to the charts. We've got a couple of people wanting to talk about the Dixie, so dollar index. If you, I'd just love to get your thoughts just on the structure of the dollar index. We talked about the dollar going up, dollar yen's being a great way to play that. But obviously the dollar index is heavily skewed towards the euro, 57% weighting. It's a basket of currencies against that. But if you're looking at the charts, we could talk about 2-year yields and various factors. But you know, how do you seeing the setup and the structure to the dollar index?
This is for me not a time to make a directional call on dollar. When I look at Euro USD, I feel like Euro USD is fairly priced at 118 to 120.
Yeah.
To be able to see a break higher in the Dixie, I want to see a little bit more new information. I'm looking at the Euro USD, for instance. Again, as you said, it's probably one of the biggest driver. Euro USD. Can Euro USD come a little bit lower and start intruding into these areas like 117? I think it can, and I think I'll be trading towards that. Yeah. But right now, Euro USD is very fairly priced at around 118, about to 120 level. I like it lower, but it's really fairly priced. So there's no this is not a golden scenario for me where I can see, okay, or this is a one-sided market, I want to cram in order. This is more like, okay, if opportunity comes to short Euro USD, I'll take it. But that's not something I actively would be running. I'll probably take it session by session and feel it out.
Yeah,
nice. Let me bring up the Dixie for you.
Go for it.
So interesting to, now we're talking technicals. Again, not a big factor in my thinking. Really interesting to know. Entire year, and nobody talks about this, Dixie was been actually holding up pretty well. So from the start of the year, pretty much since I believe the Democrats won the Senate, dollar kind of just was on an appreciative path. So for us to be able to break that, it looks like the things that we know already isn't breaking Dixie down any further. It looks like that bottom is holding based on the information we have now. So we need some new information. We need something new happening either from the ECB. They need to make the move on tapering, or they need to make on rates, which is highly unlikely. The ECB will never move rates. If they move it, they will move it probably lower. So that kind of gives you the think, oh yeah, maybe Dixie should have a fair value a bit higher, specifically because it was holding lows the entire year. We're halfway through.
Yeah, nice. Right, okay. There's one question coming here from Taj. Is there any currency pair you would recommend for pattern day traders who are new to FX? Been trading indices profitably for a while now and would like to broaden into currency markets. So any currency pairs that you recommend over others for pattern day traders there, Amir?
If you've been successfully trading indices, honestly stick with it because it's such a nice market. Majority of the time it goes up as well, and you cannot fault it. The problem you have with FX market, it can go volatile and it just goes straight down into a choppy market for a very long period and just can tire people out very, very quickly. Hence, FX market is such a difficult market to figure out when those big moves are happening, what direction. If you really set on trading with patterns, I highly recommend GBP/USD. It's very reliable and it is one of the most volatile, with the lowest spread currencies out there. So you get, for instance, GBP/JPY is very volatile. Some other pairs are very volatile, but this intraday spreads the brokers offer are quite wide, sometimes 2 to 3 pips. GBP/USD is still one of the highest volatilities. You get usually average 80-90 pips a day movement, but your spread is usually about a pip or less. So I think you will find patterns there. If you're looking for patterns, look for London opening. You get a push there. Look for US cash opening. That's for us in London about 2:30. You get a move there, and obviously the London fix, you always get moves there. So you can work out during there and then. Another thing, and this is that I tell everyone else, usually you find GBUSD on Monday and Tuesday, everybody gets the orders in for the tier 1 news coming out for the rest of the week. And you can usually figure out where you want to be in the market.
We've got some more questions coming through here, Westy, and I just want to get to them. From B. Liz, hi Pepperstone, thanks for the live event. Are daily pivot points the same around the world, or are they calculated according to the different time zones?
What is that?
No, the pivot points are calculated off the previous day's range. So if you're going to get the central pivot point, then you're going to take the previous day's high. So it's based on the candle times, and the candle times is done off the central time. So that is one specific time. But you take the previous day's candle, you take the high, the low, and the close, and divide it by 3, and that'll give you a central pivot point, and then you can work off that. So it's just one time. Whatever the server time is, if you're using MetaTrader, if you're using our platform, MetaTrader 4, MetaTrader 5, or CTrader, it's going to be using the server time, and the candles shift per server time, and then the pivot point is calculated from the prior day's range, and then your S1, R1, S1, 2s are priced off that. So hopefully that explains. But if you've got any more questions around pivot points, do reach out to me. Unless Miad, you've used pivot points before, and you've got some.
I heard about them. I'm not sure how they work, so I don't know much about.
I use pivot points. I mean, I don't use them liberally. I mean, I think you can use them for 2 factors. One is to, if you're looking at where price is relation to the pivot point, you'll get a sense of how price is reacting against the previous day's range. Just gives you a sense of where price is moving and potentially where things could go. But I mean, for people who are using it for more mean reversion tools, so you might look to fade moves into R1 or S1, for example. I don't tend to use them for mean reversion purposes. I think I'd use Keltner bands or Bollinger bands for mean reversion purposes. But I know some people, a lot of our clients will use pivot points quite effectively. But if you've got more questions around that, do reach out to us. Miad's got no insight. He hasn't really used them before. It's not part of his strategy, but I've spent a bit of time looking at them and what sort of the predictability around those. So do reach out to us if you've got more questions around that.
Miad, there's a question right up your alley here about the London fix. So Marco De Silva says, Miad, I've had some decent success using the Monday London fix as a pivot for the week. Any comments across quite a few pairs? Or should I look for a London fix that lines up with the supply or demand zone?
London fix essentially is its own supply and demand zone. You're bang on right. Monday and Tuesday fixes are really pivotal intra-week. You always find you see some sort of a reaction out of it, so you're already on the right path. Obviously, I don't want to give too much away from the course I'm offering, but what you find is Monday and Tuesday, people get in position for tier 1 announcement for the rest of the week. That's where the bulk of the money is sitting. So you can use these as the demand and supply zones. For bounces, specifically if you trade GBUSD, works crystal clear. A lot of the weeks you'll find yourself in a good decent amount of profit. Now, if there's anything else you could add to it, I would say is that sometimes you will find that some of the London fixes don't get touched. So you don't get attacked the following day, and then maybe it doesn't get tagged for another 3 or 4 days, and then once it does eventually get tagged, maybe next week or something like that, you'll find that acts usually a good strong supply and demand. You should see some sort of reaction off of that. So pay attention to these. You're on the right path. Again, mind you, London fix is where a lot of orders go through, and people put an order through that are more macro driven than possibly technical. So they will be more interested where the economic calendar is driving them to take positions on.
Are we shorting euro dollar based on that spread differential that you just had on there? I think that.
Remember the 3 things I talked about, the 3 things that will change the way probably most trade forex. So quick explanation what this chart is. This is the 10-year yield on the Bund minus the 10-year yield on the US Treasury, right? And that will create a sort of a chart like this. this candle chart. This orange one here is Euro USD. And in my experience, Euro USD will eventually always marry up where that yield spread is. Most of the times they trade together, so there's no dislocation. Sometimes it starts dislocating for any reason. Sometimes it might be a short-term driver holding Euro back. Sometimes it might be somebody that's holding USD back. Sometimes it's options. Actually, most of the times it's probably options holding market back from breaking out the volatility. And then it starts marrying up back to the yield spread. So I'd like to show you two big events where Euro USD aggressively started moving back into the yield spread after it dislocated. One was when I actively traded. It was obviously again 2018. So this was the yield spread. It started peeling away in November 2017. And Euro USD did not pay attention until around 400 pips higher and about 3-4 months later. And then Euro USD started all of a sudden moving down where the yield spread was. See it? Look at that. Yield spread was already knew already where Euro USD should be going. Euro USD didn't know it yet. And it started moving down. Another one we had in 2019, which was one of the most painful ones because it just dragged on for nearly 8 months, was this one here. A yield spread bottomed, but Euro USD was keep noodling about. And it did not actually make that big move until later in 2000, I believe. It did not start kind of making a good move in September 2019. Did not actually make the big move until Fed started spending $6 trillion in March 2020. And Euro USD then kind of moved again back to where the yield spread was. And guess what? This year, yield spread were going down again, and people were calling Euro USD at 225, 230, 240. Guess where Euro USD went? It went back down with the yield spread again and again. So pay attention to this yield spread. It's going to save you a lot of money on making you're going to be good, really, really accurate with your directional calls, because yield spread is already telling you where the currency wants to go. And that is accurate for all the currencies in the FX realm.
Miad, we've got quite an interesting question related to your course, and I think it's a useful tool of trading around events and stuff like that, important events. And Richard asks, does your course teach straddle trading on news events?
Hi, Rich. No, it doesn't. Reason being is that what we don't do, we don't hedge, obviously. We go full on in on the positions we take. A lot of the times we don't actually take positions before the event. We take the positions after the event, like today. There was a little bit of a delay when we wanted to jump in, and the market moved a little bit too quickly, so I wasn't able to show you the trade, but did show it to the members. And so we got in there and kind of got out at 39.10. But straddling isn't something I use because I never found it worked. Never worked for me.
I think for me in the options world, if you're using a slightly different thing, if you're using straddles and buying volatility or selling volatility, I look at the options market as a guide to understand how much of a move is expected over a news event. So you can see you can work out the implied volatility and work out whether that's higher than usual, and you can tell whether the market's thinking that's going to be a volatility event. And I use that quite effectively in risk management. But the straddle will price the exact move, and of course, if you're buying volatility, you'll break outside of the wings. But it will tell you what the market's expecting for movement over that time frame. So it can be really useful. I mean, a lot of clients will use things like the average true range and you know, various sort of realized volatility measures to look at that situation. But for straddle traders in the options world, you know, I think that they can give you really good insight for risk management purposes if you're just trading generic spot FX. So you know, I really, you know, I think I dig them, to be honest. I think they've got a lot of statistical input to your trading situations there.
Miad,
last
we're
one.
going to wrap this. Yeah, last two questions, Miad. It comes from one viewer. Should beginner traders go with major pairs or crosses?
Well, it depends. Are you a swing trader? Are you intraday? Intraday, the spreads are brutal. Sometimes even if you want to hold them overnight, the overnight spreads just sometimes can spike easily 20-30 pips. And it's not because of the broker. Mind you, the broker hasn't really got a price to work with because futures are short for a 1 hour period. So you have to cover the bases and just widen the spreads to you. So if you do like crosses, be mindful if you do hold them overnight. It's going to get very difficult. I find I make most of my money on on some of the major pairs, specifically because the transaction costs are low, i.e. the spreads getting in and out of trades is so lower. Mind you, the volatility is lower as well, and that sometimes can get frustrating when things aren't moving.
Yeah, you're paying for the movement. You're paying for the movement at the end of the day, aren't you? If you're going into the exotics, you know, the spread is a fun, and you might get a 2% move in dollar SAFA, whereas you're only going to get a 0.5% move in euro dollar. So you might get a slightly wider spread, and we're pretty competitive in that field. But if you're looking at you pay for the movement, so they're kind of equidistant at the same time. So.
Those are very interesting points, Miad, especially for me coming from South Africa, seeing my currency fluctuating all over the place with lots of volatility. Final question from Azim. What are the key bonds, because you were speaking a lot earlier about the yield spreads and how important that is in sort of the way you analyze FX, Miad. So he said, what are the key bonds that you look at when trading G10 FX and the difference in the impact of the yield on the FX rates?
Good question, Azim. So depends what currency pair you trade. So if you were to trade euro against USD, those two bonds on the 10-year become important to be able to make directional calls in the medium term. For instance, if you were to pull up your euro USD chart and then put your yield spread up on that chart, they'll give you indication where the moves are headed. And that also means if you find it difficult to analyze euro USD, sometimes it's easier to analyze the bond market because that's much more structured. It's not all over the place. It usually moves in 5 basis point moves. It makes life a little bit easier for you. So always pay attention to the countries where they're running the bonds from or they're issuing the debt from to be able to figure out the direction.
Cool. Well, I'm going to wrap it up, but Miad, you've been really generous with your time. You've got some really great insights about his three-pronged process. And for people out there who haven't looked at the bond market, I think that's a really great place to start. And Miad's talked about that at length. We've looked at the London fix and how he can use that for more predictable situations and some really interesting trades around that. So, yeah, if you've got any questions about Miad's process, do reach out to him. He's big on Twitter. The Speculators trading website will give you all the information about getting hold of him and looking at that process. So again, just another one of the people that we've spoken to in the live trading series who've got a really unique process that they've honed over the period of time. And I think a lot of people out there who are still refining your process and looking to get definition and create an edge. I think Miad's given you a really clear alternative for how he's gone about starting his journey in true trading and going into becoming someone who's teaching people about situations. So to reach out to him, as I say, thank you for your time. For people who've been watching these videos consistently, we really appreciate that. There's been a huge amount of questions today, so really cool to get that engagement going on. If you find yourself enjoying what Miad said and Luke as well, myself, then obviously give it a like and we'd appreciate that. Subscribe to the channel. And if you've got any questions around anything that you've heard around like Pepperstone or anything, obviously reach out to the team here and we'd love to wrap that up as well. So thanks again, and thanks for joining this series this week.
Thanks for having me. Bye, everyone.
Cheers, Miad.